Good morning, everybody. Hopefully this is working well. There is a little bit of a delay on the Facebook. Let me switch. Good morning, everybody. Peter Barnowski is here. Today I would like to talk to you guys about how to retire early through investing in real estate. Unfortunately, it looks like I've had a wrong picture on the screenshot for a second, but we are going to be focusing on early retirement through real estate. Let me switch to my presentation mode. And so what are we going to talk about today? Today I want to focus on several things, and one of them is what do I mean by when I say retirement? A lot of people are going to be, I'm a long way from retirement, why should I listen to this? Please stick around. I think you'll enjoy it. And then next we're going to talk about the difference between savings for retirement versus investing for retirement. Then we're going to talk about why invest in real estate and why is it effective. Then we're going to talk about a real life example of a deal that I just got under contract, that I already have, that I'm already going to be purchasing if everything goes smoothly. And then finally I'm going to talk about what do we do at Choice for Homes and in the context of this conversation. So jumping into it, let me see. What do I mean by retirement? So some things I want to level set before we go into the conversation. So this conversation has nothing to do with age. Retiring, in my understanding, is breaking away from having to work for a living. It has nothing to do with how old you are. If you can manage to retire by the age of 30, I admire you, and go ahead and do it. Retirement is not a function of savings. You don't need to have $10 million in the bank to be able to quit your job. And then retirement is all about creating passive income to exceed your expenses. Why is that? How is that different from having a large savings in your bank? Savings in your bank is money. It sits there. You can invest it in various. So if you just have the savings and you stop working, the savings are going to start running. You're going to be using them up. There are various ways of investing that savings to actually have it produce income, so the savings hopefully don't run out or don't run out as fast. So when you're creating passive income to exceed your ongoing expenses, is a process of basically how do you replace your paycheck with an investment income? A couple of things are going to happen when that happens. You're going to reduce your expenses significantly by reducing the amount of taxes you pay. Most people don't realize it, but one single largest expense, ongoing expense that an average W-2 employee has are the taxes, the income taxes. On average, depending on your income level, people would be paying between 25 and 35 or even close to 40% of their retirement, of their total earned income in taxes. In Rich Dad Poor Dad book, Robert Kiyosaki, he actually, I really liked the way he explained it. He said, an average employee in the United States works from January through May for Uncle Sam. The other thing that happens when you're in a W-2 income situation, taxes come out first. So what you earn and what you bring home are not the same things, and taxes come out first. And then we're going to talk about building passive income stream that is sufficient to cover all of your ongoing expenses. So in other words, if you choose to stop working for a living, you would never run out of money, and you would be able to maintain your current lifestyle. Now, for most people, being able to retire if you say, or becoming financially independent does not mean they're gonna sit on the beach all day and drink beer or fish or whatever your thing is. For most people, retirement would mean not having to work for a living, not having to work for your paycheck, and actually being able to focus on something that they enjoy doing. And at that point, you are like in my case, I enjoy doing real estate and I enjoy doing this, and so that is my retirement, if you would. The only difference for me is I spend a lot of time building possible retirements for other people, and so that is actually more of an active work. But let's go to the next slide. So saving for retirement versus investing for retirement. What's the difference? Saving is for retirement, of course, is diverting a percentage of your income into a retirement account and building it up. Now, is it possible to invest without savings? Yes, it's possible. It's difficult, but it's possible. You can invest a little bit at a time. Is it possible to save without investing? Absolutely. A lot of people do that. A lot of people do something that is almost in the current world is almost like savings without investing. You put your money into a Roth or something like that that's not really producing huge amounts of income. But the most effective way is save up first, build up those savings, and then use those savings to invest them and have that money make more money for you. What is the difference between investing and working for a living, or having a W-2 income, or having a job? When you have a job, you are exchanging your time, your skills, your passion and energy for money. When you have a job working for someone else, it happens at a specific rate, and most of the time you need to be there, and there is only so many hours a day that you can trade for your income. In other words, if you're making $100 an hour, and you won't be able to make more than 2,400 a day. It's 24 hours if you're there the entire day. But of course there are rules and regulations that kind of prevent that from happening. The other side of that is when you're self-employed. At that point you are exchanging again your time, your energy, your skills, possibly you're reinvesting some money into your business, but most of the time you are there and you are creating wealth. And at that point, it's not a set rate. You could be making a lot of money as a self-employed, and it might not be dependent on how much time you spend there, but generally, if you go away, so does the income. Now, it is possible as you grow and become an entrepreneur and you hire people, you could actually hire people to hopefully replace you at your business most of the time, but it's still an active business. Now, how does investing comes into that? Investing is you're switching the concepts. Now, instead of trading time for money, what you do is you're making your money create more money for you. And so money are working for you. That is an investment concept, and it's a passive investment concept. Passive means that your money is going to keep making you money when you're not there. Now, can you just totally leave and check out? No, that's not how it works. You still need to keep track of your investments and manage them. But the point of it is you can go away for 6 months, come back, and you would have still earned 6 months worth of income from your money, unlike trading time for money. I hope that makes sense. So let's talk about the next slide. Investing in conventional instruments. So let's talk about the next bullet. Once you have a certain amount of savings, you can start investing them into various instruments, and there are plenty of them available out there. You can buy stocks, you can buy bitcoins, there are plenty of mutual funds, there are plenty of retirement funds. Lots of people out there offering products that help you create money from money. None of them are free. All of them are going to have a different rate of return. And most of them, when you want to pull money out of them, you either getting the money at a very low rate, and for example, I was looking up high dividend stocks, and Procter and Gamble came up, and it's considered one of the high dividend large company stocks, and the amount of dividends you get is between 1 and 2% a year. So if you were to put in $1 million into that, you would get what's 1% of 2 million, $10,000 a year in dividends. Anything more than that, in order for you to get it, you would have to start selling off the asset. And of course, as you start selling off the asset to pull money out, the asset is no longer there, and it no longer produces dividends. So that's why I like investing in real estate, because real estate is one of the very few instruments that, if done right, can produce significant cash flows without actually having to sell the asset, without without an asset being consumed. That is specific to a cash flow strategy in real estate. I mean, a lot of people will buy real estate, hold it, sell it, and make a bunch of money. That I call that appreciation strategy, and it's more of an active investment. And there's nothing wrong with that. Don't take me wrong. Any investment strategy out there can be used effectively and should be used in a proper mix by an educated investor. I'm going to be talking about a cash flow strategy, and how do you take real estate and buy a specific type of real estate to where it will always produce cash flow without ever running out, and furthermore, you would be able to do other interesting things with it. So why invest in real estate for cash flow? Why is it effective? I'm going to start with, generally it's safe and recession proof. The type of real estate that I invest in is a Class C, lower income type of housing. If you were to look at a large Seattle market, they would be cheap old houses that are renting out for $1,000 to a couple thousand a month, $1,500 a month, and so on. Section 8 housing. A lot of the housing that is actually is very recession proof. We've seen in the past that when economy goes down, the sales prices get depressed first, and then the rents get depressed. But they usually, when the rents do get depressed, they get depressed from the top down. In other words, your most expensive rental units are going to get vacant first, and the tenants from those units will generally move to the less expensive units, and so on and so on and so on, until they hit the bottom and there is nowhere to go, right? So generally your lower income housing is actually going to have a higher demand in a poor economic environment than vice versa. Now, one point of risk, of course, is when you have a government shutdown and nobody is getting paid, and if you are on Section 8, there could be some delays with payments there. Generally, I consider real estate, cash flow real estate, is a fairly safe and recession-proof investment instrument. Of course, there are other risks associated with owning those assets, and those would be vacancies, and those would, but most of those risks are operational. Evictions, bad tenants, bad management companies, and they can be managed. The macroeconomic risks, though, are not going to impact you nearly as much. Okay, money never runs out. So if you were to invest enough money and buy enough assets to produce a large enough passive income, and you want to exceed that income, that money will last forever and will be passed on to your heirs and your children. Because those properties, I mean, General House right now, I mean, if you look at, again, in Seattle market, there are houses on the market that's been built in early 1900s. 1902. I own a building that was built in 1905. We're going to remodel it, and it's going to be great for another 100 years. So take care. If you take care of your assets, if you take care of your real estate, they will always produce cash flow. Unlike your conventional 401ks and other retirement instruments that once you retire, you kind of start eating away at that balance. So that creates two things. One, if you live too long, you'll run out of money. B, you can't retire too early unless your retirement account is huge, because again, you're going to live longer than your money lasts. With passive real estate, that's not the problem. If you end up, if you manage to build 1,000-unit portfolio by the age of 30, and that 1,000-unit portfolio is cash flowing $40,000 or $50,000 a month, you can stop at that point and you can go do something else and do whatever you want, and that income will always be there. It will always pay your bills. The ability to leverage, and this particular ability makes investing in cash flow real estate is very effective. In other words, what is leverage? Leverage is ability to borrow money, invest it, and then get income or get return on investment on someone else's money. Kind of sounds a little more complicated than it really is. If you were to buy an asset, let's say for $1 million, and you borrowed $800,000 from a bank at 5%, but that asset was bringing in 10%, then you would be making 10% on your own $200,000, and then you would making half of the 10%. In other words, 10% minus the 5% that goes to the bank on the remaining $800,000, right? So let me do the math really quick. Sorry, I should have prepared it ahead of time. But 800,000 times 0.05, so you'd be making $40,000 divided on bank's money, in addition to making $20,000 on your own. So total, you're making $60,000 on a $200,000 investment. That's what they mean by leverage. You'll see that in the example below. I'm not aware of any other type of investment asset that would allow you to leverage quite as easily as in real estate. And when you're in the realm where you're buying one house at a time, especially early, you can leverage with a conventional mortgage, which means your money is going to be really cheap. The loan to value is going to be really high. You're going to need very little money to actually buy something that could cash flow for significantly well. Now, the key always is going to be, is your cash flow high enough to do so? And so the key is always find good properties. Ability to pull out gains without selling the asset, refinancing. This is a really cool feature of real estate, and nowhere else, again, I'm aware that where you could do that. Like, you couldn't take 1,000 shares of Procter & Gamble and say, hey bank, could you lend me some money so I could, against that as a collateral, so I could go buy. You could do something like that when you're a larger company, and you could borrow against your investment assets. But for most of us, average Joes or slightly above average Joes, that option usually is not open, at least not for long term. With real estate, it's kind of easy. You bought an asset that's cash flowing at 10% cap. You owned it for a few years. The value of that asset increased. You can go ahead and refinance it with a bank, pull out some of the equity that you gained from that asset, still own the asset, still have the cash flow. Now, the caveat there is if your cash flow needs to be high enough to cover the new mortgage payment after the refinance. And it actually needs to exceed the new mortgage payment in order for it to make sense to keep the asset. In other words, if you are cash flowing $10,000 a month, your old mortgage was $5,000 a month, now you went in and you pulled additional 25% of the value out, so now your mortgage became $7,500, you're still cash flow positive at $2,500 a month. Now, if you flip the numbers and all of a sudden your total cash flow is $7,500 a month, now your new mortgage is $10,000. Now all of a sudden you no longer have an asset; it's a liability. You have to pull money out of your pocket every month. What you just did there is you traded money now for cash flow, and that's actually you're better off selling that asset most of the time. So keep going. Tax advantages. Let's talk about tax advantages. W-2 income is the highest taxed income out there. when you are generating rental income, most of that income is going to be an investment income, so you would probably be paying about 20% tax rate on that if you are not doing it right. If you are doing it right, there should be a significant enough depreciation expense that you could set off a large portion of that income against, and your effective tax rate is going to be even lower. But to give you an example, the deal that we're going to look at in a few minutes, it's a $1.2 million deal. That's cash flowing. That's probably 80% or higher value of the improvement. So 1.2 times point, let's call it 80. So $960,000 are your appreciable value divided by 30. So you're going to be able to write off about $32,000 a year of the profit from that deal in depreciation for the first 30 years, which is a nice additional bonus. So let's take a look at the example that I prepared. This example is actually a true real deal that I just got under contract last 2 weeks ago. I'm in the process of doing due diligence on it right now, so most of the numbers are fairly firm already. So I'm just gonna look at it high level. The deal is in Chicago. The deal is for 21 single-family homes in Chicago suburbia, kind of 30 or 40 minutes out of downtown Chicago. So let's talk about purchase price. So the actual purchase price for this deal is $1.2 million. I said 1.27 here is because 72,000 is going to be various closing costs, points, inspections, appraisals, other things, other costs that is going to come in, and that's what's going to cost us to purchase the deal. The loan is going to be 75% of the 1.2 million. So the down payment is actually going to be closer to 30% of the 1.27 because it's basically 25% of 1.2 plus the 72,000 difference. Hope that makes sense. If not, poke me and I'll explain it better. So let's talk about the income on the property. I just want to do one thing really quick. I want to open Facebook and see if anyone is asking any comments or questions. And it looks like nobody. So we're good to go. Scheduled rents. That is how much money you're going to collect from your rents if all of your units were occupied and before any other expenses. That's basically number of units times your scheduled rent for that unit times 12. That never happens, of course. There is generally going to be some vacancy, some management, other operating expenses. I've already done the math for this property. 122,000 of that 279 is going to be operating expenses, leaving you net operating income of $157,000. That is an equivalent of a cap rate of 12. It's an effective cap rate of 12.5%. Why do I call it effective cap rate? Because for the purposes of the investment, I look at a cap rate as a function of the total acquisition price, not purchase price. So the seller is going to have a higher cap rate in his books because he's getting 1.2 million for it. I'm paying 1.27. So there's a slight difference there. What does cap rate means? Cap rate means is what is the return on investment before any type of financing is taken to the account. So were we to purchase this deal with cash, we would be getting a return on investment of 12.38%. That is an unleveraged return. So that would be 1.57 divided by 1.27, or 1.2 million. Now, since we are going to be leveraging, so we're going to be leveraging at 75%, we are going to be borrowing some money. And we're going to be borrowing money at 5%. I already have that calculated. So your annual interest expense of the $907,000 loan is going to be $45,000. So 157 minus 45 would give you an income after interest of $112,000 a year. Now, if you were to take that and divide it by the amount of your down payment, 364, that would give you your return on investment, which would, in this particular case, is 30%, 30.8. It's a really nice return on investment. I mean, don't take me wrong, this is a sweet deal. This is one of the higher cash flowing deals that I've been able to contract in the last 6-7 months. Okay. The loan that we're getting is not an interest-only loan. It's actually a 30-year amortization. So the expectation is that we are going to be paying off 1/30th of that loan every year. So that's your principal payout of $30,000. After that, you actually are going to get cash money of $81,000 a year on hand, and that is a cash-on-cash return of 22%. And that is a fairly good deal in any market that you look at. I challenge you to go and find another investment that's going to produce that type of returns on an annual basis. Now, what else does it mean? It means that you're going to be getting on average $6,800 check every month. Why do I say on average? Well, because a lot of the expenses are budgets, not true monthly expenses. In other words, things like maintenance or capital expenditures. You're going to have multiple maintenance events in one month, none on the other. So your number might jump, it might be high, it might be low, but on average, you should be getting $6,800 a month. And that is based on the actual performance of the property. I usually don't base my numbers based on target or projected rents or projected expenses. What I try to do is I try to say, how is the property performing right now? It's performing at $6,800 a month. Now, is there an upside on this property? I believe there is a significant upside on that, and we can probably push that number higher. So if you were to buy this investment, like if you were to find this deal yourself, structure it, purchase it, and own it, it would be an equivalent of having a job that pays $8,000 a month. Why the difference? The difference is the tax rate. On this investment, you would be this is before tax. You would be getting $6,800 a month. After tax, let's say 20% tax on that, you would be taking home 50 something, 5,200, I think. I did the math on it earlier. So 5460 you would be taking home. Now, were you having a job with a take home of 5460, and if you were in, let's say, a 36% tax bracket, you would only be getting 64 of that. So that would be an equivalent of having a job that pays $8,500 a month. $8,500 a month is not a bad paying job nowadays. It's $100,000 a year income. So why is this important? To replace a job that pays $100,000 a year, or to replace the income equivalent of the job that pays $100,000 a year, you would need to spend $364,000 in purchasing an asset like that. And at that point, you would be able to retire if that was your financial goal. Now, if you want to be retiring with an income stream of $200,000 a year, then you would need to do this twice. Do you need, now I'm going to go back and I'm going to talk a little bit more on this slide. So does it mean that you would need to have $600,000 or $720,000 of available savings in order to buy two of those deals? Well, yes and no. If you were to buy them at the same time, you would need double the amount of money. However, if you were to buy this deal, cash flow it for a year or two, and then do a cash out refi and be able to pull most of the down payment out, then that money becomes available to you for buying another deal. And that is where real estate investment allows for much quicker growth if you do it right. So if you buy the right deal at the right price in the right spot, then refinancing becomes fairly easy. And in a 2, 3, 4, 5 year term, you can be getting all of your investment back while keeping the asset. Now, granted, your mortgage payment would go up, and you would no longer be getting a net cash flow of 81,000. You would be getting closer to maybe 40, were you to pull three or $400,000 out from this deal. But you would be able to buy another deal, refinance it, and do it again. So this is not a get rich quick type of scheme. This is a disciplined strategy of investing money in your first portfolio, cash flowing that, refinancing, taking that money, reinvesting into your next portfolio, and then doing it enough times to produce the free cash flow that you need in order to be comfortable for the rest of your life without actually having to work. Now, can you still work? Absolutely. Go do whatever you enjoy. Start, do a startup or work as a barista part-time, or become a boat parking guy. My goal is to apply again for a volunteer ski patrol this winter, or maybe next winter, and use some of that time that is now available to actually go and do things I really want to do, whether they pay my paycheck or not. And that's the financial freedom of passive cash flow. All right, so this is what a deal would look like if one of you were to go and find that deal yourself, find financing yourself, structure the deal, and take the loan, guarantee the loan, find the management company, find the inspection, find the contractors, get it all set up, get it all in place, and then kept an eye on it, and just did it all by yourself. If you have the time and expertise to do that, go do it. Don't need me for that. But if you don't, I do. And here's what we do at Choice for Homes. So we find high cash flow deals nationwide. I have a number of relationships that I work with. I have deals brought to me off the market. I go to trade shows. I talk to property management companies. I'm constantly in this environment of looking for portfolio deals, and we specialize in single family houses portfolio deals. In other words, I'm looking for portfolios of 10 or more single family houses sold as one package, as opposed to multifamily, an apartment building, a 10-unit apartment building. Why do I prefer single family homes? Go to my YouTube channel, just search for Choice for Homes on YouTube, and my channel will pop up, and there is a video there that talks for half an hour. I talk specifically about the difference between investing in single family homes and multifamily, with numbers and everything. Next step, I'll conduct a financial analysis of the deal, and I'll do due diligence. Are there any hidden costs? The revenues really what they are? Are there any hidden vacancies? Things like that. Then we'll find and secure financing, appropriate financing for the deal. I have a relationship with maybe a dozen lenders. Each lender will lend on a specific type of portfolio. Not everyone is going to lend on everything. Some portfolios we can get cheaper money on because there's a better lender doing it. Others, they might not want, they might be too rural or too low priced. There are different reasons why lenders will and will not lend on certain portfolios. But I structure that. The other thing that those lenders will do is your interest rate is going to depend on how experienced you are. Were you to approach them as a new starting up investor, you wouldn't get 5% interest. You would get something more like 7% interest. Which is on a $1.2 million deal, is going to add up to a significant difference every year. We set up operations. I don't manage the houses themselves. What I do is I find third-party management company in the local market, and actually find 2 or 3 of them, and we'll go with one and have the other 2 as a backup. And then I'll provide long-term management of those companies, because you have to manage the manager. Otherwise, your management suffers, and then they're not going to do as great of a job. Again, if you want to learn what happens with if you don't manage real estate portfolios correctly, again, go to my YouTube channel, and there is a video there that does a case study on a portfolio that I recently saw, which was in real trouble. And then we'll provide financial reporting, so we'll hire bookkeepers and accountants to produce monthly reports and present them to us, first of all to us, so we can manage the portfolios, and also to the JV partners, so they can know how the investment is doing and what they're getting. We'll also set up and then the next step is we'll actually set up a one-on-one joint venture partnership with one of my JV partners, and we'll actually team up and we'll go and we'll buy those portfolios. The portfolios that I look at, they range from, let's say, maybe $750,000 purchase price, to the biggest one I'm looking at right now is close to $4 million. So there is a vast variety of different portfolios. Now, the other thing that I wouldn't that I'm considering of doing is maybe taking a large portfolio and then splitting it into smaller pieces and kind of collaborating with several people on those. And then the final thing what we'll do is we'll business manage the JV and the portfolio long term, and that includes figuring out if and when it makes sense to do the refis, working on actually pushing the rents up and increasing the income of the portfolios, maybe budgeting some money for creating the properties to push up the rents, or focusing on reducing the costs, general strategy and business management of the portfolio. So that a lot of people asked me in the past, Peter, what is it that you do? And then I said, I'm going to do a presentation on that. I'm going to talk about first why I do it, and second I'm going to talk about what is it that we do. So what's in the future for Choice for Homes? The ultimate future would be to become a fund, and that is a few years down the line, and I still have to take a few steps to get there, but that's the ultimate goal. So if you liked what you've heard, if you think the information is useful and you have any more questions, reach out, don't hesitate. I'm always available via email. Here are the contact information for us. Email anytime, phone, please. I'm on the West Coast, so if you are in Florida, please don't call me at 8 o'clock your time. I probably won't pick up. And then, of course, every video that I do, I save on my YouTube channel, and I'll usually post a link to that on both Facebook and LinkedIn. So if you enjoyed this video, subscribe to the YouTube channel. This way you will know whenever something new comes up, and also click on the little bell icon, which will send you a notification when a new video is posted. Anyway, hope you've enjoyed this presentation, and I will be doing something new next Monday at 11 o'clock, or maybe 12 again, like today. Again, I don't have a specific topic for next week. If you have a topic that you would like for me to talk about, please let me know, and I will gladly try and incorporate it. Thank you.